Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and with me is Mike, our industry expert. Today we're diving deep into Archer Aviation's 10K filing for fiscal year 2025, filed March 2nd, 2026. Mike, this is a pre-revenue eVTOL company burning through cash while racing towards certification. What's your immediate read?
If we reduce this filing to one sentence, it's this. Archer is executing a high-wire cash burn strategy with $1.02 billion in liquidity to reach commercial operations before the money runs out. Based on this filing, Archer Aviation is operating an early recovery phase. They're transitioning from pure R&D burn toward operational readiness, but they're not generating meaningful revenue yet. The company reported just $300,000 in revenue for the full year, essentially hangar lease income from their Hawthorne Airport acquisition.
That's a razor-thin margin for error. Let's break down what changed materially versus their last filing. What are the key metrics telling us?
The operating loss widened dramatically to $729.3 million, while net loss came in at $618.2 million. But here's what's critical. Research and development expenses jumped $136.2 million, or 38.1% year over year. In the MD&A section, management stated this was primarily due to increased investment in people and materials to advance technology development. They specifically called out a $48.4 million increase in personnel costs from workforce expansion and a $46.3 million increase in stock-based compensation.
So they're scaling the team aggressively. What about general and administrative costs?
G&A exploded by $83.4 million, or 54.9%. Management attributed this primarily to a $68.3 million increase in stock-based compensation expense. When you see stock comp increases of this magnitude, we're talking about doubling down on talent retention while burning cash at an accelerated rate. For context, most established aerospace companies run G&A at 8-12% of revenue, but Archer is in pre-revenue mode, so these are pure cash outflows with no revenue base to absorb them.
Let's examine management's commentary signals. What tone are they striking in this filing?
Management is projecting confidence despite the cash burn reality. In the MD&A, they stated, "Our commercial readiness progress is driving growing global demand across Europe, Middle East, Africa, and Asia Pacific for this new category of transportation." That's notably optimistic language. They're also emphasizing their participation in the EIPP. That's the White House initiative to accelerate air taxi deployments in American cities. Management specifically mentioned partnerships across California, Florida, Texas, Georgia, and New York for initial air taxi operations.
But what about the international strategy?
The UAE is their lead international market through what they call the Launch Edition program. Management stated they're on track to deliver additional Midnight aircraft this year in preparation for initial passenger operations. This is significant because it suggests they're moving from prototype to actual aircraft delivery, even if it's limited scale. They've been working with the UAE's GCAA, that's their federal aviation regulator, to establish the regulatory pathway.
Now, let's talk about the financial red flags or confirmations. With over $700 million in operating losses, what should investors be watching?
The cash position is the make-or-break metric here. They reported $64.7 million in cash, cash equivalents, and short-term investments as of December 31st, 2025. But here's the critical calculation. If they maintain their current quarterly burn rate, which we can estimate from the annual operating loss of $729.3 million, that's roughly $182 million per quarter. At that rate, they have approximately 10-11 quarters of runway, or about 2.5 years.
That's assuming burn rates stay constant, but they're scaling up operations.
Exactly. Management explicitly stated they expect research and development expenses to increase significantly, as we progress towards commercialization and manufacturing. If this trend persists and burn accelerates to $250 million per quarter, their runway shrinks to under 8 quarters. That's the causality chain investors need to monitor. Higher burn rates directly compress the timeline to revenue generation or force another capital raise.
What about their debt position?
Total debt is relatively modest at $80.3 million, all long term. They have a $65 million credit facility with Synovus Bank for their Georgia manufacturing facility, fully drawn, with interest-only payments through October 2026. They also assumed a $16.1 million loan from the Hawthorne Airport acquisition. For a company with over $1 billion in cash, this debt load is manageable and doesn't create near-term liquidity pressure.
Let's move to risk disclosures. Any new risks or escalated language in this filing?
The filing notes that no new or significantly escalated risk factors were identified versus the prior filing. However, the inherent risks remain substantial. Management acknowledged in the MD&A that development timelines, the probability of success, and development costs may differ materially from expectations. They also stated they cannot determine with certainty the timing, duration, or the costs necessary to complete the design, development, certification, and manufacturing bring up due to the inherently unpredictable nature of our research and development activities.
That's pretty standard language for a development stage company, but it underscores the execution risk.
Right. The biggest risk factor isn't disclosed as a traditional risk. It's embedded in their business model. They're racing against their cash runway to achieve FAA type certification and begin commercial operations. Every quarter of delay in certification is roughly $180, $250 million in additional cash burn with no revenue offset.
Now, let's examine their liquidity and balance sheet stress in more detail. How comfortable should investors be with their financial position?
Management stated in the filing that they believe that our existing cash equivalents, and short-term investments will be sufficient to fund our operations for at least the next 12 months. That's the minimum going concern language. But with nearly $2 billion in liquidity, they're well capitalized for the near term. The real question is whether this capital is sufficient to reach cash flow positive operations.
What's their path to revenue generation?
They have 2 planned revenue streams. First, commercial air taxi operations, which requires completing FAA certification of their Midnight aircraft. Second, defense applications through their partnership with Anduril Industries. Management noted they announced their first deal for third-party adoption of these technologies in the defense sector in November 2025, with Anduril and Edge Group using their electric powertrain for the Omen autonomous air vehicle.
Let's break down the segment-level performance. What are the winners and losers in their business lines?
This is where the pre-revenue reality becomes stark. Their only current revenue source is hangar leasing at Hawthorne Airport, that $300 Australian dollars in annual revenue. Management stated in the MD&A, to date, we have not generated significant revenue from these planned areas, referring to both commercial and defense segments. The commercial segment is entirely dependent on aircraft certification and air taxi network development. The defense segment is in early partnership phases with Anduril and the DoD's AF Works program.
So we're essentially looking at 2 business lines that are still in development phase.
Correct, but there are operational milestones that matter. They're scaling production at their golden manufacturing lines in Silicon Valley and their high-volume facility in Georgia. The fact that they're moving to manufacturing scale-up, even in limited quantities, suggests they're progressing beyond pure R&D toward operational readiness. The UAE aircraft deliveries they mentioned could be the first meaningful revenue catalyst.
Finally, what should traders and investors be monitoring going forward, and what's your counter thesis?
Key monitoring points. First, quarterly cash burn rates. If they exceed $200 million per quarter consistently, the runway compresses dangerously. Second, FAA certification milestones. Any delays in type certification directly impact their timeline to revenue. third, the UAE operations launch, which could provide the first meaningful revenue validation. Management expects revenue to increase as they develop and bring additional hangar spaces into service and expand offerings.
And the counter thesis?
Here's our if wrong clause. If Archer achieves FAA type certification by mid-2026 and begins generating $50 plus million in quarterly revenue from air taxi operations while maintaining quarterly burn below $150 million, our high-wire execution thesis is wrong. That would demonstrate they can reach cash flow sustainability within their current capital base. Additionally, if their defense partnerships with Anduril generate $100 plus million in near-term contracts, it would provide a revenue bridge while commercial operations scale.
How does this stack up against our initial thesis?
The evidence from this filing confirms our core thesis. They're burning $729 million annually in operating losses while generating essentially zero revenue. The aggressive workforce expansion and R&D spending increases show they're doubling down on reaching commercialization, but it's compressing their timeline. At current margins, which are deeply negative, this equity trades like a binary bet on certification and commercial launch success, not like an established aerospace operator.
Any final valuation framing?
At nearly $2 billion in liquidity against $729 million in annual operating losses, investors are essentially buying 2-3 years of execution runway. The company is valued on the assumption they'll successfully navigate FAA certification, scale manufacturing, and launch commercial operations before the cash runs out. It's a high conviction bet on the eVTOL market timing and Archer's execution capabilities.
That wraps our deep dive into Archer Aviation's 10K filing. Remember, this analysis is for informational purposes only and should not be considered investment advice. Always consult with qualified financial professionals before making investment decisions. Thanks for joining us on Aviation Intelligence Weekly. I'm Sarah.
And I'm Mike. We'll be back next week with more aviation market analysis.